All right, so someone made this comment on a video I made about MREIF mortgage, which is a mortgage plan in Nigeria that gives loans at 9.75%. So just quickly check out the comments. So when evaluating lending, mortgages, and basically finance, first thing you need to look at and think about is what the inflation rate in your country is. In Nigeria, the inflation rate is 16%. It's been 16% averagely since independence in 1960. If you average it across time, Nigeria's inflation rate is 16%. Across the 5 years is about 22 plus percent. Last 5 years. So does it make sense for you to keep money in your bank account when you know next year it's going to depreciate by 16%? What that means, what inflation means is essentially that this headphone set I bought today, next year, is going to be 16% more expensive next year. Essentially, I'll need 16% more to buy it next year, averagely. Now, when you couple in things for Nigeria's housing market, when you couple in things like the demand in Nigeria's housing market is crazy, and it's only going to keep increasing. In the next 10 years, we're going to be expecting about 60 million people, 50 to 60 million people in our urban population alone, urban cities alone. Now, that's the entire population of Kenya. So, if we are bringing in an entire population of Kenya in our urban centers, what will happen to price? Price is only going to go up. Coupled with inflation, you should expect higher prices, generally speaking, because there'll be so much demand. And we only produce about 100,000 houses every year, formal houses every year, at least currently in Nigeria. So saving is not going to help you, to be honest. Just from a pure mathematical perspective, it's not going to help you to save. It's the reason why land banking is very lucrative and a lot of people are doing this. Right? That's why there's a lot of demand in land banking. Because people that buy land and houses know that land is essentially a store of value in Nigeria. Housing is a store of value. People buy houses and land to protect themselves against inflation. So with that knowledge, when you see somebody essentially giving you a loan that is below inflation, you should jump at it because it means the cost of housing in the next year is going to be more expensive. In the next year, it's going to be likely more expensive. This 9.75 fixed across 20 years. So when we're thinking about interest rates, because this is something that we get a lot of people asking and talking about and commenting about. The rate is 9.75, is too high. Inflation is 16%. The bank is giving you money, essentially. So people should think about that when evaluating your choices, because people will only think about now, but we need to think about that's what finance is, predicting the future with data you currently have. What's it going to look like in 2 years, in 3 years, in 5 years? And the truth is, if you don't, I don't know how to explain this any better than the bank is giving you money, essentially. It may not be giving you now, it may not look like they're giving you money, but essentially, they are essentially lending you money for free, 6% for free, because it's below inflation. I hope this helps someone anyway. Thanks and bye for now.